Hi everybody, hi everyone. This is François Hablé for the financial broadcast as we used to do at Friday. I hope that you're doing very well, and it's your first time to discover me. I'm the main trainer and founder of Global Street Trader Academy (GSTA), which is a financial academy where we teach people how to trade stock, bonds, option, indices, forex, and all the stuff. So I kindly recommend you to keep in touch with us if something interesting you, because we're here to give you for educative tools, educative content related to your activity of trading, informative too, and we do your framework and your follow-up. Okay, so please share this video at your friend if they have interest for trading, and let a comment and also put some notes at the section reviews on Facebook, and you can also subscribe to this page and also follow us to the YouTube channel, right? So I just make it a quick video just for helping the most of retail trader, which is our aims, right? That's why we giving we make it easy the life for you in terms of microeconomics, on the information on financial markets. And that's why I make this quick video in terms of this decryption of this Fed boss speech that we got yesterday in Wednesday. So as we see on the screen right now, we have a point of view which is we are fundamental analysis. Bias will be a technical analysis, and conclusion of what I'm thinking about this major announcement and what the thing that we have to expecting to the future with the Fed and with the dollar too, as we will see right now at on the screen, right? So we got some, as I said, we got some a announcement as the Fed and the Congress, because we see Jerome Powell speak about the Congress, which was a testimony in terms of I think the third probably the third meeting on the financial market, and to show the beige book, and also to describe all the strategy for the Fed in terms on the long term. And this is where we see on the screen. This is the Fed chairman point. He said there is no evidence of imminent recession. He said again, inflation risks are roughly balanced. He said again, we must cut tax to support economy at least for the next 2 years. And finally, the gradual rate hikes as the best path for now, which is something that it's a point of view. I'm not challenging the boss of the Fed, because he has like the also he's very a smart guy, and he know what he's doing. But I have also the right to not agree with all he said, because I have also my economics point of view of that. So my point, what is my point of view exactly? Of course not. He said there's no evidence of imminent recession. Of course not. We see clearly the recession coming. Why? Because first, most of economics and Nobel Prize estimating already that the next recession will coming probably in the second quarterly to the next year, which is 2019, right? And that's why the Fed right now currently very hurry and worry about the global financial markets warming, and that's why they increase the interest rates, because they feel that they have delayed, that they have to do that before at the governance for Janet Yellen and the 2012, and she didn't doing that. Okay, she let the market go with the flow, and it was the easy money right there. So that's why now we kind of feeling some of like delay on the financial markets, and if they cannot like stop this easy money, we can have like a global financial market warming, and it could like kind of rushing on the recession, because the recession as they expected to the second quarterly on 2019 is just an estimation. But we see at the level of the US rate, US, like they call the 10 years or the 2 years, rate yield US, getting into the highest level, to the 10 highest level, right? So that means we are like very on the top on the production of the global economic, right? So this speech that Fed chairman said is just to ensure that the market not worry about that. But as a professional trader or professional or institutional trader, they know that it's just it's a poker face, is a poker liar, right? And you have to very understand what they're thinking right now, because all the productivity, the level of productivity of United States are very high, and the ratio of debt and GDP as very also absolutely amazing. And United States are very debt, so they need to increase, like to produce just from $1 they need to spend $100, which is absolutely crazy, right? So in terms of this, like to be concrete in terms of this situation, that means the United States are very in jeopardy in terms of the recession. Okay, so it's why those reasons that I not believe what he said, that there's no evidence of imminent recession. 2 points. It said the inflation risk is roughly balanced. It's a tricky announcement, because I will show you a document that the Fed has published at the 27th March, the last March 27th. They published kind of report where they placed the anticipation for this year and second year, and also to 2020. And you will see, I will show you that they reduce, they decrease the anticipation on the GDP, right? So if they like put some kind of, if they decrease for the anticipation for GDP, that means they know that they will probably will be hit by the recession potentially, and we will see like a major correction on all the major asset or major index, right? And I will show you that. He said again, we must cut tax to support economy at least for the next 2 years. If the government looks good, if the government everything doing well, why they want to be supported by the government? Because if you don't know, I can tell you that the bonds are inverted correlated with inflation. Okay, and when we have inflation, it doesn't good for a bond. Okay, because money cost like very money is very expensive. So when we have like a solid or a nice trend of inflation, it doesn't good for a bond, and that's why we can have kind of crisis debt, which is starting before the recession is coming, as we saw with the subprime crisis in the recent financial crisis to 2008, right? It's starting by the debt. Okay, so if the economy looks good, why you want to be supported by the government, which is cutting tax and giving again like policy for to spend money a lot, as we saw again at the 2008. If the government that didn't intervene in the economy to save the banks, they will all screw up. Every bank will be screw up. It's because the government intervened on the economy to save economy. That's why we saw that in 2009 the yield curve, which is show like the way how the market or how the shape of the market is going, and we see that it's currently going up, and is on the highest top, right? So that's why I said it's not I'm not agree with what Jerome Powell said, that if we don't need support, and that's why we got a shutdown in January, because we cannot financing all the activities for the federal government in the United States because they are severe debted. And if that's why also the president of United States, Mr. Donald Trump, did want that they increase the interest rate with the same rhythm that they're doing right now. Okay, and it show also how the Fed could be affected by the transparency and the also independency. Of course, the independency, they say the independency and also the transparency, but the policy of the Fed president didn't according with the politics of the Fed, right? So that's why I'm not agree with that. And the last things which is I want to tell you is they said the gradual rates hikes are the better for now, right? I agree with that because it's something, the way to prevent and to anticipating a potential global financial market warming. And that's why I will show you on the next screen why the anticipation, which is that the document published to the 27th March, said the inverse of what the Fed chairman said at at yesterday and the endorsement. Okay, so I will show you that right now. As we see on the screen, so the Fed economy and inflation anticipation is this document that you can find. It's public. You can find at the website of the Fed, and you see here clearly that in terms of economic in models of economic modern, we saw that we observe generally the empirical study that the economy, the growth of economy must follow the inflation, right? They work together. And when you see here the GDP in real, the change in real of GDP, which is the variable, at median here in 2018 to 2020, we see that the change of GDP decrease each year after each year, and the longer run, which is kind of the target or the triggered, is 1.8%, right? So that's why I told you that don't like believe them, because they just make a communication to ensure that people like everything looks good, to increase the sentiment index, or the sentiment of like people will believe in this policy, and to continue to inject money and also to stimulate the growth, and probably we will help them to getting into this triggered. But in the reality, and if it was like confident in this like policy, they have to doing the update this publishing, but they didn't get it yet. Okay, it's still the same document that I show you. So that means they believe in that. That's probably we will have kind of a slowly recession, or probably a severe recession. But of course we will get some recession, or like a kind of like a retract of economy, right? It depends on the frequency, and depend also on the impact that it could have. So we saw here clearly that the 2018 to 2020, we have 2.7% to 2.0%. And if you also take a look on the PC, which is personal consumer index inflation, we see that we have 1.9% to 2019 to 2.1%, which is the long run, which is like January, or statistically we have a 2% target or trigger for the inflation, right? Any central banks doing that. So we see clearly that we have a gap between, again, the GDP and the inflation, because they didn't like going in the same direction together, because they're supposed to do. If we have kind of good health in the economy, the inflation is supposed to going in the same rhythm with the GDP, right? And it is, we see through this table that it is not doing that with the expectation and the anticipation. So that's why I told you each time that in intraday trader, as a trader, like retail trader, you need to be if you're doing day trading or swing trading as me, you need to be also like very careful about the way where the market is supposed to going, because all the assets, major assets, are related to dollar. Okay, don't follow people who said we don't care about the economic or macroeconomic data. Yeah, of course we care about that, because if you don't know where the market goes, even you have like 100 indicators, you'll be fooled. Okay, so that's why I'm just like killing me to show you all the properly way to know how the market is supposed to go and what's the bias. Okay, so now we finish with the bias, which is the we finish with the fundamentally analysis, which is my point of view, and I will show you now for a bias technique analysis on the graph here, and I choose for you, I will just adjust that. So I show you on the screen the graph of the gold and also the graph on the Nasdaq. Okay, and gold, you see this moving average is a moving average for the adjusted for the based on 2 years. Okay, so it's a moving average which is 730 periodically from the daily. Okay, so daily, so that means it's a moving average for 730 years, 30 days. So sorry, so it's 2 years. Okay, so we see clearly that we break gold, and it's kind of like stabilized. It's a range of the moving average. So that means we clearly neutral. Even the any announcement could like destroy for sure the market, but we're not destroying that the market will break like efficiently the this moving average. It could also going to take a next lowest and rebounds and will be back to the previous level. So that's why I will draw for you a landmarks on the financial markets. I can take some rectangle here. So this is the zone of the resistance here. Okay, like in broadly way, and after we can have some if I can show you here technically where we can exactly pay as much and as well the gold. Okay, so we have here there you go. Right, so this is the kind of zone that we can definitely pay gold, because when we see also Donald Trump is it's going to the press, and he's doing a negative comment about the Fed policy, and also he doing some is kind of trespassing the independence and the transparency of the Fed, right? Because he wants that the dollar will be low and cheap, then the United States could be competitive to the exportation, right? And now it's very a nicely context, because they're doing kind of they call trade war, but you know my point of view, I'm not agree again with the term that they use, because market worry about the possible retaliation of China if they also follow the sanction that the United States like anticipating, or to add an additional 10% of $200 billion on the products that they have to do, right? So if they're not doing that, probably because it's very a massive sanction tariff. So that's why we could expecting that the gold could drop until this this zone. I will show you again where is my point of so we look at that here, right? So you can expecting that. So don't be like don't be on the rush to pay gold. Okay, let the comment and also the anticipation and the speculation on dollar, because you will see in the end of this program my conclusion on that. So you can let the comment and let the market anticipating for the possible hiking rates on the next meeting, which is expected to the 29th September. If they're doing that, the market will probably already anticipating the dollar. So the level we also like anticipating on the highest. So there is nothing to do after that. So the market will not like surprised by the eventual hiking rates, right? And it would be probably the third time to do that in this year, right? Before that, they're expecting to increase 3 to 4 times. After they decrease this anticipation, they said 2 to 3 times, and now they will be back to the 3 to 4 times. So that's why I'm just keeping. I'm just be patient for that. And some people also, I show this. I will show you the screen because there's some like also a pattern that I already post to the social media. We have a draw line here. We break it. Sorry. So we break it possibly here. We got some a contact, 1 contact, 2 contact here. So we stuck on this level, right? So probably if I'm like show you the screen correctly and you see the trap on the graph here, we see the trajectory of the graph is starting to have like two contact here, right? We eat in 1 time and 2 times, and it's like very kind of double times contact, which is kind of double top, right? Double bottom, sorry. And then we see the rally, right? And it came back again at like a kind of this same level almost, and we doing a V top, a V bottom, sorry, and then we going back in the top, and then we probably approach the same level here to probably take some a rebounds to going back, and this level giving to us at the 1200 right here, or 1200, right? So here, so that's why I recommend you to let the market going to in this level, and this level is a psychologically level to pay the gold, because it's represent the same like the previous annual on the 2015, and we test so many times on that, and we see it on the charts. So that's why I recommend you to be very patient with that. Just let the market the gold be bullish until the 29th September, which is my conclusion personally, and then you can have some strategy to buy gold, which is mine personally. Okay, after that everybody can doing his own strategy. I'm not imposing my strategy to anybody, but I show you for the trade, like for the retail trader, if they're interested to trading like that, it's for me it's the best way to do. Also on the Nasdaq, as we see here, we have a nice bully trend line, And again, it's starting to the 2009 after the severe crack on the financial market. The market rally and it goes up like very from the long term. And then I will just like hold on a second, just adjusting my screen. And again, we also doing the previous stop, which is the 7,500 here, and we never get into it. Okay, we never break it. We just doing some kind of lateralization. Okay, so that's why I also recommend you to to be patient for that, and to let the market continue his movement. But because when we see this kind of pattern, we know that is this ascending wedge, they supposed to going back. All right, the ascending wedge has a probability of 75% to finish at the downtrend. Okay, so that's why we have to wait about that, and probably we will see that the market could, if it's fell again on the previous highest, like at the 7,500, then you can now take a position for short the market, because we see clearly here on the graph, which is the bias that I talked before. So we see one time here, two tests here, 3 test, and 4th test. Okay, and it could also like doing some kind of pullback, going back to retest again, and after we will break it. If it's doing that, you will see clearly that it's materialized some of double top, as I show you quickly before to finish this financial program. So we see clearly right there in the financial total. Okay, so that's why I definitely recommend you to just stay now how the market and just let it him, and I will give you for sure the signal for which is the best time to optimize the timing to short the market. If what people follow me on Facebook, Twitter, and also on Pinterest and Instagram, I posted some analysis there to show what's the perfect time to shorting the markets. Okay, so that's the potentially scenario that we can have with on Nasdaq. And on the fundamentally bias, it's because with the trade war that they call, some of a Chinese investor would like to put like massive money on the technology company, which is they work with ZTE Corporation of the leader of telecommunication in China, and they have some filial on the United States, and also they want also put some money on Netflix, on all this stuff. And the president of the United States, Mr. Donald Trump, did want to do that. So he want to block all the massive flow investment. So that's why we see some pressure on Netflix. They lose like 40, like almost 40, like I think 4% in one day. And also we saw like couple of technology or company lose money on that, because they're expecting that the money come from China, but the actual president that did not want to do that, right? Because they are on like struggling on the war, like on the trade war that they call. So that's why I recommend you to be very careful of that, and to not let the market go into euphoria, and to think about this bias that I show you, to build your strategy, and also to construct also the kind of scenario that the market could show you before to take a position. So this is my my way and my thinking about that. So to finish this program, I will show you again the graph for the dollar. As we see on the screen, now we're getting back to the top for my screen. There you go. So as you see here on the dollar on the 1 hour, which is very short term, I draw a white line here to materialize kind of the POC, which is point of control, right, where the sellers and the buyers are getting caught. And we see clearly that the moving average are very, it's very trend to going up, and we already make the previous low, which is I think it's 92.77, right? The middle of the market is 93.85 points, and the possible top that we made already, it's close to the 95 points. Okay, here 95.50 points. So here, so we have like probably the two, we have probably the two top here. So even that we as much as we stay below that, I'm considered to be neutral. And if you fell again on this level, just like be bearish on dollar and buy indices until the previous top, as I show you on the Nasdaq, right, on the 7,500. And because they are inverted correlated even at the Dow Jones and even at the S&P 500. Okay, and then if we also fell on this level also, which is, sorry, this level, okay, it's pretty much the same level, because it's not like exactly the same, this is not exactly the same level, but if we can go in here and to fail, you can fail on this zone here, not here or not here, but we can fail until between this level. Okay, if you fail that, then you can also pass to short the US dollar, and that means that the market don't have the strength to push up and to going on the previous top, right? So that's why I recommend you to now to be very careful to just stay out the market. On the day trading, if you do scalping or intraday, for sure you can be like relatively bullish on the dollar. But if you do day trading or swing trading as me, I'm just recommend you to let the market go, to be just patient, and to let the market or the dollar rally with the comments, to ensure people to giving like nice communication on dollar. But be ready for potential, probably the potential like movement on the dollar, and I'm expecting that the dollar will be bearish on the long term. And what about also this scenario as the dollar, right? We can have like possibly kind of this movement as we see here, right? A possible right, we can have a possible a head and shoulder, right? As we say here, we have a head and shoulder here, and probably another shoulder here. So we can have kind of massive movement here, and then a rally again, and then a comeback, and we going to see the previous level. It could be this scenario, or why not, maybe we can have also some of rally here, and if you fail here, right, it's still again also the it's still again a double top, because we fell 2 times consecutively in the same zone, right? So that's why I recommend you, my scenario is definitely bullish, bearish in the long term on the dollar. So this is my vision on dollar, and I hope that you won't be trapped on this scenario, because most of retail traders didn't know about the terms and all the announcement or the Fed communication. So that's why I made this video for you to make it easier and understand what you have to think about on over the next month or the next coming years, as I described to you. Okay, so this is the conclusion. So be bullish on dollar until the 29th September, and after be bearish. Okay, so this is that's why I finished this video. I thank you so much for watching this video, and if you like it, for sure, please leave a comment, show to your friends again, leaving a comment and put some note on your like reviews section on Facebook. And also I see you around on the next video. Thank you so much, and it was François for Just Canada. Bye bye.